Preparing for a risk analyst at Generali interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is the role of a risk analyst in an insurance company such as Generali? A risk analyst helps the insurer understand which events could affect solvency, earnings, liquidity, or reputation. I would analyze underwriting, market, credit, operational, and emerging risks, test exposures against limits and scenarios, investigate unusual movements, and communicate findings to decision-makers. At Generali, the role also means linking risk analysis to enterprise risk management and regulatory capital. I would aim to provide commercially useful insight, not simply produce reports, while maintaining strong controls and independent challenge. While answering, focus on identifying, measuring, monitoring, and reporting risks, connecting analysis to capital protection, supporting management decisions, and balancing technical accuracy with clear communication across business functions. Question 2. Why do you want to work in risk at Generali? I am attracted to Generali because insurance combines financial analysis with real economic and social impact. A risk role would let me study how underwriting, investments, capital, and operations interact across a large international group. I also value the long-term perspective. Good risk management protects policyholders and supports sustainable growth rather than chasing short-term results. My strengths in quantitative analysis, structured problem-solving, and clear communication would help me contribute while continuing to learn the insurance business. Make sure to cover your interest in insurance, the importance of risk discipline in a diversified international group, Generali's long-term perspective, and how your analytical, collaborative, and ethical qualities match the role. Question 3. What are the main risks faced by an insurance company? The main categories are underwriting risk, including pricing, reserving, catastrophe, mortality, and lapse risk. Market risk from rates, spreads, equities, currencies, and property. Credit risk from counterparties and bond issuers, and operational risk from people, processes, systems, or external events. Liquidity, strategic, and reputational risks also matter. I would avoid viewing them separately because correlations and concentrations can amplify losses, especially during stressed market or catastrophe conditions. In your answer, distinguish underwriting, market, credit, liquidity, operational, insurance concentration, strategic, and reputational risks, then explain how interactions between risks can amplify total exposure. Question 4. Can you explain Solvency II and the Solvency Capital Requirement? Solvency II is a European insurance regulatory framework built around 3 pillars: quantitative capital and valuation, governance and risk management, and disclosure and reporting. The Solvency Capital Requirement represents the capital needed to absorb a severe, defined level of unexpected loss over a 1-year horizon. I would also distinguish it from the Minimum Capital Requirement, which is a stronger supervisory floor. In practice, analysts monitor solvency ratios, capital quality, diversification, and management actions. Be sure to mention the 3-pillar structure: risk-sensitive capital requirements, eligible own funds, the SCR, minimum capital requirement, governance, reporting, and the purpose of protecting policyholders. Question 5. What is the difference between the Solvency Capital Requirement and the Minimum Capital Requirement? The SCR is the risk-sensitive capital requirement designed to cover a broad range of significant risks at a specified confidence level. The MCR is a lower, simpler threshold representing the minimum capital level below which policyholder protection becomes unacceptable. Falling below the SCR triggers a capital restoration plan, while breaching the MCR creates more urgent supervisory consequences. Therefore, management should maintain a meaningful buffer above both thresholds, considering volatility and recovery options. Focus on their different purposes, calculation concepts, supervisory implications, breach consequences, and why management monitors the SCR ratio well above the minimum rather than targeting the floor. Question 6. How would you assess an insurer's solvency ratio? I would calculate the solvency ratio as eligible own funds divided by the SCR, then assess both the numerator and denominator. I would examine the quality and fungibility of capital, recent trends, business composition, diversification, and sensitivity to rates, spreads, equities, catastrophes, and model assumptions. A high ratio is not automatically safe if capital is volatile or risks are understated. I would compare the result with internal appetite, regulatory expectations, and credible management buffers. Make sure to cover eligible own funds divided by SCR, capital quality, trend analysis, business mix, sensitivities, management buffers, regulatory thresholds, and why a high ratio alone does not guarantee low risk. Question 7. What is ORSA, and why is it important? ORSA is the Own Risk and Solvency Assessment, an insurer's forward-looking process for evaluating whether its risk profile and capital are adequate over the business planning horizon. It combines strategy, risk appetite, stress testing, solvency projections, and management actions. I would treat ORSA as a decision-making tool rather than a document produced for compliance. For example, growth plans, reinsurance changes, or asset allocation decisions should be tested against adverse scenarios and available capital. In your answer, explain the Own Risk and Solvency Assessment, forward-looking perspective, risk profile, capital adequacy, stress testing, business planning, governance ownership, and distinction from a purely regulatory compliance exercise. Question 8. How would you perform a stress test for an insurer? I would begin by identifying material exposures and selecting scenarios that are severe but plausible, such as a rapid rate increase, widening credit spreads, equity falls, a major catastrophe, or simultaneous stresses. I would translate each shock into impacts on assets, liabilities, earnings, capital, and liquidity, including relevant correlations. Then I would test management actions, such as rebalancing or reinsurance, and compare outcomes with risk appetite. Finally, I would document assumptions and model limitations. Talk about defining material risks, selecting plausible severe scenarios, translating shocks into financial impacts, considering correlations and management actions, assessing capital and liquidity, and documenting assumptions and limitations. Question 9. How do interest rates affect an insurance company? Interest rates affect both the market value of assets and the discounted value of insurance liabilities. Falling rates usually increase the present value of long-duration liabilities and may reduce reinvestment yields, while rising rates can reduce bond values and create losses if assets and liabilities are mismatched. The net effect depends on duration, guarantees, product design, and hedging. I would analyze parallel and non-parallel curve shocks, spread movements, cash flows, and solvency impacts rather than relying on one sensitivity. Be sure to cover asset and liability duration, present values, reinvestment risk, spread effects, guaranteed benefits, accounting impacts, different life and non-life exposures, and the importance of scenario analysis. Question 10. What is asset-liability management, and why is it important for insurers? Asset-liability management aligns investment assets with the timing, currency, duration, and behavior of insurance liabilities. The objective is not simply to maximize investment return, it is to earn an appropriate return while controlling rate, spread, liquidity, currency, and reinvestment risks. I would compare projected asset and liability cash flows, duration gaps, and scenario outcomes, including policyholder options. Effective AUM helps ensure claims can be paid and capital remains resilient when markets move sharply. Focus on matching asset cash flows and duration with liability obligations, controlling interest rate and liquidity risk, maintaining return objectives, considering optionality and guarantees, and supporting solvency under stressed conditions. Question 11. How would you evaluate credit risk in an investment portfolio? I would assess credit risk by reviewing issuer, counterparty, sector, country, rating, maturity, and seniority exposures. Key measures include probability of default, loss given default, expected loss, rating migration, concentration, and credit spread sensitivity. I would also review collateral, netting, guarantees, and recovery assumptions. Monitoring should combine quantitative limits with qualitative analysis of financial strength and liquidity. Under stress, I would examine correlated defaults and the impact on both portfolio value and solvency capital. Mention issuer and counterparty exposure, ratings, probability of default, loss given default, concentration, migration, collateral, spread sensitivity, sector and country risk, and stressed recovery assumptions. Question 12. How would you assess underwriting risk? I would assess underwriting risk by comparing premium adequacy and expected claims with actual frequency, severity, loss ratios, and expense ratios. I would segment the portfolio by product, geography, customer, coverage, and distribution channel to identify adverse selection or concentration. I would also examine reserve development, catastrophe accumulations, policy terms, and reinsurance protection. Persistent deterioration could reflect pricing weakness, claims inflation, or changing exposure quality, so I would connect the analysis to corrective underwriting actions. In your answer, discuss pricing adequacy, claims frequency and severity, reserving, exposure accumulation, catastrophe risk, policy terms, portfolio mix, reinsurance, and differences between actual and expected loss experience. Question 13. What is reinsurance, and how does it reduce risk? Reinsurance transfers part of an insurer's exposure to another insurer or reinsurer. Proportional arrangements share premiums and losses, while non-proportional covers respond above a retention, such as excessive loss catastrophe protection. I would evaluate the retained risk, limits, exclusions, reinstatements, pricing, counterparty credit quality, and potential capital benefit. Reinsurance can stabilize earnings and protect solvency after severe events, but it does not eliminate risk because recoverables may be delayed, disputed, or unavailable if the reinsurer fails. Cover risk transfer, proportional and non-proportional structures, quota share, excessive loss, catastrophe protection, counterparty risk, retention, limits, reinstatements, and the balance between capital relief and cost. Question 14. How would you investigate a sudden deterioration in an insurance risk metric? I would first validate the data, definitions, timing, and calculation before assuming the risk had genuinely changed. Then I would decompose the movement by product, region, asset, counterparty, or model component and compare it with prior periods, budget, and expected ranges. I would speak with underwriting, investment, actuarial, or finance teams to understand business drivers. Finally, I would quantify materiality, assess whether limits or capital are affected, document the root cause, and escalate recommended actions. Explain validating data first, decomposing the movement, comparing actuals with budgets and prior periods, identifying business or model drivers, consulting stakeholders, assessing materiality, and escalating with documented recommendations. Question 15. What would you do if business management disagreed with your risk assessment? I would first understand which assumptions or objectives caused the disagreement and check whether my analysis contains errors or an incomplete business context. I would then present the evidence, methodology, sensitivities, and potential consequences in a balanced way, distinguishing facts from judgment. If disagreement remained, I would document both perspectives and use the established risk governance or escalation process. My goal would be constructive challenge, protecting the company without unnecessarily obstructing commercially sound decisions. Be sure to mention listening objectively, testing assumptions, separating facts from judgment, presenting evidence and scenarios, preserving independence, escalating through governance, and remaining constructive rather than confrontational. Question 16. Which key risk indicators would you monitor for an insurer? I would monitor indicators across risk categories rather than relying on one headline measure. These could include the solvency ratio and capital buffer, loss and combined ratios, reserve deterioration, catastrophe accumulations, lapse or mortality experience, duration gaps, spread and equity sensitivities, credit concentrations, liquidity coverage, operational incidents, and limit breaches. I would use thresholds, trends, and early warning escalation. The most useful dashboard would connect each indicator to an owner, potential impact, and predefined management action. Discuss solvency coverage, capital buffer, loss and combined ratios, reserve development, catastrophe exposure, market sensitivities, credit concentrations, liquidity, operational incidents, limit breaches, and trend-based thresholds. Question 17. How would you use Excel, SQL, or Python in a risk analyst role? I would use SQL to extract and join exposure, claims, investment, or counterparty data. Excel for transparent reconciliations, sensitivities, and review schedules, and Python for repeatable analysis, large datasets, simulations, and automated reporting. For example, I could build a script that compares current exposures with limits and flags concentrations. I would apply version control, input checks, independent reconciliations, and clear documentation. Automation should improve reliability, not replace professional judgment or challenge. Focus on data extraction, reconciliation, transformation, exposure analysis, automation, visualization, reproducibility, validation controls, and knowing when judgment and stakeholder review remain essential. Question 18. How do you ensure the accuracy and integrity of risk data? I would establish clear data lineage from source systems to the final risk report and perform completeness, accuracy, consistency, and timeliness checks. I would reconcile key totals to finance, actuarial, or investment records, investigate exceptions, and retain evidence of review. Automated validation rules can identify missing fields, duplicate records, unusual movements, or breached limits. I would document assumptions, changes, and remediation owners, while ensuring independent review for material outputs and preventing uncontrolled spreadsheet overrides. Mention source controls, reconciliations, completeness checks, validation rules, exception reports, lineage, version control, segregation of duties, manual review, and documenting remediation of data issues. Question 19. Tell me about a time you identified a risk or control issue. In a portfolio reporting project, I noticed that one instrument category was missing from a concentration dashboard after comparing totals with the accounting file. I traced the issue to a classification rule applied during data transformation, quantified the effect, and informed my supervisor before the report was distributed. We corrected the mapping, reran the analysis, and added an automated reconciliation between source totals and dashboard totals. The experience reinforced that careful validation and early escalation are essential in risk reporting. Use a specific situation action result structure. Explain how you detected the issue, quantified its significance, collaborated with stakeholders, resolved it, and improved the control to prevent recurrence. Question 20. What questions would you ask the interviewers at the end of a Generali risk analyst interview? I would ask which risk areas and business units the team considers most important over the next 12 months, and how this role contributes to those priorities. I would also ask about the main systems and reporting processes, interaction with actuarial, investment, finance, and local risk teams, and how analysts challenge assumptions. Finally, I would ask how success is measured, what training is available, and which current project would provide the strongest early learning opportunity. Ask about team responsibilities, major risk priorities, reporting and systems, stakeholder interaction, development, success measures, current projects, and how the role supports Generali's broader risk and business objectives. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.